I would review it if there's huge moves between now and the 29th, the 30th of June. I'm not expecting that. I don't think you should either. This is not bullish for the next 6 months. Since the pivot, since wash, and now that we're very close to bait-in and there's no major news events that will affect monetary policy and rates between now and this being a locked candle, we can now say was a big turn, and that's a shooting star. And that means, well, you're probably looking at another red candle. And I would say, even if you fixed this in the fastest possible way, I would still say the best way you fix so that we can start going up again is the next 6 months.
Precious metals may still have a long-term bull story, but the immediate chart message is caution. A 6-month shooting star changes the timing, even if it does not destroy the bigger thesis. FrancisHunt, a respected technical trader known for the HVIF method and long-range target mapping, argues that recent weakness in gold and silver should be viewed through candlestick structure, timing, and risk control rather than simple bullish excitement. The main warning is that silver is unlikely to move violently higher in the short or medium term. After the recent wash event, the cleaner expectation is another red candle, sideways pressure, or a grinding sell-off before a healthier reversal can form. The fastest constructive fix would be a sharp early drop followed by a strong recovery into the final part of the 6-month candle. Without that, the market may simply burn time, trap early bottom pickers, and force patience. The better stance is to respect the bearish momentum now while keeping the larger upside case alive for later. That balance matters because timing can decide whether conviction becomes real profit. Now, we present the clips from FrancisHunt's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
This is not bullish for the next 6 months. Since the pivot, since wash, and now that we're very close to bait-in and there's no major news events that will affect monetary policy and rates between now and this being a locked candle, we can now say was a big turn, and that's a shooting star. And that means, well, you're probably looking at another red candle. And I would say, even if you fixed this in the fastest possible way, I would still say the best way you fix so that we can start going up again is the next 6 months. And this is the fastest way I can see it getting fixed. So you're going to be waiting, friends, since this event. The fastest way you could get it be fixed is you could say open there. You need to acknowledge this bearish momentum, which could involve an AI crash. You have a bit of a sell-off of some scale to at least give me a wick approaching the shooting stars. It doesn't have to be as long. It could be as long. It could even be a tiny bit longer before coming all the way back in the final 2 months and making a hammer. Then you could argue you've respected the blow-offness and intra 6-month reversal with a similar capitulation and rally, which is now seen off the bearish side. That would be a potential negation that I could then be optimistic to say next year, January through to June, you could be seeing a green candle, and it could even be a lovely one. It could be a belt-hold one if there's a lot of that. And that would be the fastest. That's where you're getting exactly what you want candles. You could, of course, have red candles, spinning tops in between here, grinding lower, weak, but not giving you, listen, if we got to puke, just get it done. Puke and reverse and come back, bouncing back. You could have just slow sickness, degradation, and grind, which could take up a lot of the time. Now, you will see reversals earlier on lower time frames, but you will tend to pick more false bottoms. When on the primary trade that we traded, which we got wrong on wash, it was a weekly hammer. Now, I still consider weekly quite a strong time, and it was a green weekly hammer on silver, and you had some rejection also on gold. Not as strongly. Gold, and we got to talk about gold because gold is God market to silver. So it's a bit like we're talking about an altcoin here, but we haven't checked Bitcoin market. There is an element of that, only Gold is the original God market, and silver is the original correlated market, rather than the other way around. But we will look at gold too. But for this to happen, those are the two ideal candles, and you're only next year at soonest potentially getting, and that's one of the more optimistic candles you could possibly draw. So that's how you fix a shooting star. It's not in a hurry. What does this mean? It means if the gold market assessment doesn't undermine what I'm saying here on silver, and I know it already and it doesn't, that you're not in a hurry, since this wash event was a final nail in the coffin, going to be going wildly up in silver. Not in the short term or even medium term are you going to be going violently up in silver. You're more likely to be degrading, which is burning up time and slipping, or selling off. Looking for longs on precious metals, given the recent wash events, is no longer going to be an alpha producing activity in our view for at least a medium term, going into, depending what your definition of long term is, but medium long, I would say, kind of like medium rare on your stake. Not quite the long term, but medium long. And that's what silver is showing us. Does gold show us anything any different? We will go to the chart and have a look at that in due course. But I want to just highlight our prediction that was in the 330s, that was in the Jerusalem Post, and why it came about. It is produced not by a cup and handle that only triggered there. The reason we were in at 25, and by the way, we had a primer here, which was why we took our friend Brent on, who we recently met in Cape Town, when he was saying, look, there it goes, it's at 25 and it's going to do its pilgrimage to 26. That came in roundabout there, literally as the primer was triggering and beginning its journey. It was a key point. And that was why it was so fascinating that the comment coincided it. It had a bit of Brown's bottom vibe about it in terms of the gold market and Gordon Brown for us at that time, because what we were seeing as significant, few others were at that point in time. And that's why we were already on record calling for 330 at 25, and being featured in September last year. That actually would have seen you get September, October, November, December, and January's gains, rather than being featured February, once the big move had already taken place, and saying you're going to revert back up very soon before the end of summer. No, you made second interim, and you've had a number of setbacks that see a more likely sustained pullback for now. Not forever, not forever. You may get your idealized candles and you may be ripping back to the 330 level, but it's most likely that the next 6 monthly candle is at least a red one, unless it is a very violent early puke and reverse one. To me, my preference, let's just get it done if we've got to sell off. I want to get back to when I'm longing silver. That's my favorite moment. Catching these candles is where you make your money. You get in early there. That's where you manage your risk, your reward, and your sizing. Everything else happens on the move. The market makes you the money. That was your winning candle, and that was the quarter leading up to December and the first month. The first month, which we sold the wick on at 118. Yes, we told you. We even told you on Twitter. That even though we didn't have to, we got out of our leverage trades. By the way, in terms of blue pot, none of this matters to me. Blue pot is almost a fundamental position for me, sound money. And that is held, and I continue to stack. I will continue to stack. I will time my stacking. Right now, I think there's no rush, and I think the discussions about shortages have calmed down a little bit. I don't think there's an endless supply, however, but I do think you'll be able to buy it, and you might get cheaper prices to do so. But you may wait a long time, and you may have to send your money out a whole bunch sooner. So you pay up front, and you wait longer, especially if you're buying the way we choose to buy. And that is scale. Okay, so timing will get you cheaper silver longer. Longer run, This is your target. So what about the timing for the target? Well, here was when the worst case safety line for when you should have made absolute, you're running behind schedule if you hadn't made your second interim. Here was the timeline. And these are always generally hopelessly overperformed to, and to be meet, particularly on big time frame ones, to meet the end target time frame means you're failing, something's gone wrong, the momentum has been stymied, new forces have come in. These are like long stop dates. These are not target dates. These are, there's something wrong, get out. There's something wrong. The original idea, the original momentum, the original setup has had a countervailing force. You're gestating, you're taking too long, you need to get out, and we close on those levels. And that is this purple line there for the 330. To illustrate how much quicker we moved to get to the second interim, the triggering event, let's clean our face up. So now we're talking about timings, because actually Michael Oliver's not wrong for me. In fact, he's going to go beyond 500 in our opinion in due course. But the timing was his problem. The timing was his problem. So he followed us, it feels. I mean, he may come to his own conclusions. I'm sure he didn't see ours and put something out. But we had already said 300 well before him, and you'd captured a run up to 120. But once that's triggered, everyone gets bold, and it brings everyone forth with great predictions, often ones they won't make when it's 25. That's one of the discerning features of HVF method. We're early and we don't care to be wrong. And we will call a big geometrically generated target out, no matter how crazy it sounds to you. And I think he's right, because we've already said ourselves that you do 300. But the time frame is everything. So if you look at that, what date were you, the long stop date where you would have been deemed underperforming? We don't close on interims, because sometimes within a pattern you can be a slow starter. We definitely close on full target. So we would close on that vertical line. That's what the HVF method gives you. It tells you not only how far you do. There's nobody, by the way, just as a little irony, why you should be clicking the link and booking a call. Nobody has these tools. Nobody has these tools for an HVF setup that will give you interim targets. First interims right down there. You blew right through it, by the way. First interim time stops. Second interims, whether you're performing on time, ahead of time, or behind time at your second interim. And full targets and an absolute long stop date you've got to be out on.
The larger silver target remains important, but timing is the whole issue. A move toward $300, $330, or even beyond $500 can still belong to the bigger pattern. Yet that does not mean the market must reward late enthusiasm immediately. The earlier run from lower levels already delivered major gains, and the second interim target has been met. That makes a sustained pullback more likely for now. The strongest opportunity may come after a proper reset, not during emotional chasing near stretched candles. Physical stacking can continue as a sound money position, but tactical buying does not need to be rushed. Lower prices may appear, and even if supply tightens later, the chart is saying patience has value. The prediction is not failure, but delay, more sideways and lower action before the next high-quality upside phase. Timing can still add value. Now let's get back to the interview.
Let's have a look at gold. How does gold look? Because what affects silver must have been first affected by gold. They've got to work hand in hand. Let's have a look at it. And I'm going to bring you into the larger 6-month sphere. And it's quite clear, by the way, just as a reminder when you're here. Look at that. Bull run. But 6-month periods, 1/2 of a year, 1 full year, 18 months, then the sell-off. First part of the 4th 6-month period, which is you're going into when this ends, it's 2 years, down, you had 1, 2, 3 6-month periods down. The first half, probably, can't say half, first percentage X of the 4th down before you reject. That's the kind of rejection you want. And you're still looking at 18 months plus probably a couple more months of down travel in what was a clear bull market. There's your bull market. So people underestimate times, especially after that key pivot that occurred with the Fed. That's called, okay, we're not squeezing out of our falling wedge on the weekly as fast as we think. That was a pattern for that time frame. You're being tested. You're going to be held down a little longer. By the way, silver can still grind up for a bit. We're not saying it can't go up and then be smacked down again, and grind up a bit and then be smacked down again, and then the AI bust and then have a big spill. You know, churn, chop. It's just not going to be on the big time frame single-mindedly up. That's the key part. Big falling wedge, huge period of suppression until Brown's bottom, which we've already referenced. That was around 2000. This was a very tight trend. That was a lovely trend to be in, but it wasn't blow off. It was just steady, steady. You had very few yellow, red candles, 1 and 2. 2 6-month downs once you were coming off here. That's a doji. At 1, we'll count it to the beginning of the bottom and the return. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. 3 of those were shooting stars, by the way, getting ever more hit on that upper wick trying. You had 22 green candles and 2 red. 22 to 2. Wow, that was steady. But those were warning you. Those were warning you. You would have got out too soon. You went again. You would have got out too soon and you went again. But then eventually it came hard. So since our breakout of the 2000 that you'll remember us calling multiple times, the 3-year sideways move, we're on the 6-month chart. That was a broadening structure, you may recall. And we said once, twice, 3 times a lady at 2000, you will break and you will run for 3 and potentially more. You made the 3, you went for more, you had further wind-ups. That was during mid-year last year. You ended up trading higher from that and we ended up going to 5, 6. What is that candle though? What is that candle? If you are a technical analyst, you can only say that it is a shooting star. You can only say that it is a shooting star, I'm afraid. That means bull calling on gold and silver in the short near term on big time frames is not a smart activity. You're likely to be going sideways and down. Sideways and down. Rate change, rate vibes, fear, panic, sell. You've had a lot of central banks stock up on gold now as alternative asset. Now there's going to be a shortage of dollars. They might even be forced when they need to settle trade to sell off some gold to meet a trade deficit that they have for importing absolute must-haves. You're going to have debt, bank crises. They're going to need foreign exchange. And when they constrict the dollar circulating in an environment, given how much it's been permeated, you could have dollar strength, period, during this period.
Gold matters because it leads the precious metals complex. If gold is flashing the same 6-month shooting star pattern, then aggressive short-term bull calls in both metals become risky. The message is not that the secular move is over, it is that large time frames can demand long pauses. Past bull markets still had extended corrective phases, and this setup may need months of sideways or lower movement before momentum returns. The macro pressure also supports caution. A period of dollar strength is possible if global trade stress, debt problems, and bank crises create demand for foreign exchange. Central banks in countries that have accumulated gold as an alternative reserve could even be forced to sell some metal to settle essential imports or cover trade deficits. That would not cancel the sound money case, but it could create short-term selling pressure. The better prediction is a 2-stage path. First, a difficult phase where gold and silver frustrate bullish traders. Later, after the market has digested the shooting star damage, the bigger trend can resume with better structure. Waiting for confirmation may be wiser than trying to force the trade too early. That patience can protect capital while preserving the larger, longer-term opportunity. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.